Good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in commodity markets. Brent crude is at $113 a barrel and change today. TTF gas is at 95 euros a megawatt hour. If you don't think in those terms, it's about $30 per MMBTU versus about 8 for Henry Hub. European carbon allowances are 85 euros a ton and counting. The world looks a lot different than it did just a couple of years ago. And I think the big question is, will the rally we've seen continue, or could we see it fade? We've got a special guest here today, Mike McGlone, joining us, one of our commodity strategists in Bloomberg Intelligence, who's based in Miami, and Will Hares, normally here in London, is also visiting Miami. So this is a special Miami Vice edition. And given Mike is our guest today, we're going to start off with him. And Mike, you've seen where we've been. We're at crude over $110 a barrel. Where does it go from here?
50. Well, I don't want to hold any bars. So, yes, first of all, thanks for having me. I want to congratulate my colleagues, particularly my energy colleagues, because you've nailed this rally. And that's been very good call. I've missed it. But I view it in the macro, bigger picture. We are in the midst right now of the biggest, potentially just starting the biggest mean reversion period in your lifetimes, but probably my lifetime too. And it might be as bad as 1929. And I point that out, and I published on it this morning, and crude oil is part of it. So the first thing you have to think about when you think on your bullish crude oils, why is the price right now still about 30% below the all-time peak from 14 years ago? This, to me, is one of the most significant bear markets in history. What's happening since it peaked in 2008? The U.S., the world's largest economy, has shifted from a net energy importer, largest importer on the planet, to net energy, largest energy producer on the planet, net energy exporter, because of one thing, harnessing and rapidly advancing technology. And that's usually what happens in commodities. So I was just on a call with the gentleman in Singapore, that bastion of commodities. I really miss visiting Singapore because they get the physical more. I'm much more futures and derivative based. And his quote was, commodities are always pendulum. It's a pendulum swing. And what happened recently is the pendulum just swung the most extreme upward in commodities in about 40 years, just like inflation. If you look at the broad Bloomberg Commodity Index, which goes back to 1960 versus its 100-week, 200-week moving average, 60-month moving average, it's got the most extreme in 30, 40 years. That is the lesson in commodities. You never want to be long in that environment. In the short term, you'll be okay. It's because the elasticity of supply and demand. It always comes back. And now we have this situation kicking in where the dollar's unstoppable. I don't see what's going to hold the dollar back. You look at the trade-weighted broad dollar, highest rates on the planet, our highest, biggest, deepest market, strongest economy is the U.S. for now. So that's bad for commodities in the big picture. And if you look at the biggest commodity rallies in history is when the dollar's been declining. So that was really, it started from like 2000 and 2008 or so. That was a declining dollar period. Now the dollar's breaking out. So that's the macro. And we have the U.S. equity market starting to trick lower. And just what we saw from Chairman Powell yesterday. His quote was, we're going to be more aggressive in inflation. Now the U.S. stock market's already corrected about 20%. That Fed put is gone. They're now selling calls. The China put in commodities is gone. China's in decline. This is what we've been pointing out for years. You can see that price of copper. Copper's starting to tick down in the year. So what I'm pointing out is we might get the short-term up trade. And as I look at it as a guy who uses structured positions for people to hedge and things, and maybe you can put on a call spread in the short term. But to me, the big trade here is a 50% collapse in commodities. Broad market. It's not profound. It's happened dozens of times in history. Just look at 2000 or 1980. We put a high in the Bloomberg Commodity Index. It took, was it 20 years to take out that high? The high in 2008 in crude oil, still there. The high this year was the most extreme versus 100-week moving average ever. So I look at it as commodities are usually the victims of their own success because of elasticity of supply, and I think that's what's going to happen. But there's one exception. I think what's going to happen here is we're probably going to see a peak soon in crude oil, And that's I see the one commodity coming out ahead is gold. The problem is gold's being replaced by Bitcoin. It's that rapidly advancing technology. So I'll end on this. The one period I'm kind of bullish, at least in the shorter term, are the grains. You look at what's happening in the grains. That's where my background is corn, soybeans, and wheat. Right now, the price on the screen is double the cost of production, but that's sustainable because of what's happened in Russia, Ukraine, because of what's pushed back on fertilizer, and we don't know when that supply is coming. But a year from now, when we can really bring on more of that supply, that's going to be alleviated. With that, I pass it back to you.
Mike, I love your provocative thesis. I certainly think it's rational to think about commodities in cycles. And I want to come to Will Hares next, though. And Will, Mike's got a very interesting view. I think it runs counter to a lot of our peers on the sell side and just kind of where the street's at. How do you read the fundamentals, and how long can this rally last as you see it when you're looking at more of that supply-demand balance kind of picture?
So on supply demand, we're seeing a pretty different picture emerge. I mean, if you just look at the supply side, there is very limited flex options here for additional supply to meet climbing demand. We strongly feel that U.S. shale, which has historically been the marginal producer, is not showing the capital strength to increase volumes. We're seeing extremely disciplined budgeting from the key Permian players. We expect only 5% volume growth, and the majority of free cash being paid out to shareholders in buybacks and dividends. So we don't think U.S. shale is going to come to the rescue here. And beyond that, we have a little bit more incremental volume coming from Guyana, coming from Norway. And of course, with OPEC, we have declining spare capacity. They haven't been able to meet their quotas for several months now. Particularly from Nigeria and Angola, which are consistently struggling with their volumes. And so on the supply side, we just see extremely limited production additions coming. This is also a function of this structural underinvestment that has occurred in the industry for several years now. And that isn't getting any better. We are seeing not just capital discipline in U.S. shale, but we're seeing continued capital discipline from the Western majors as well. And within the Europeans, we're seeing an increasing share of that capex being deployed not into oil, not into gas, but into the energy transition and renewable power capacity.
Okay, I want to bring on Salih Yilmaz to respond a little bit to that. You've got a provocative note along with Will out this morning looking at the potential for windfall taxes on the oil and gas industry in the UK. Is that going to help the supply picture? And what do you make of the idea that Will was just discussing about where the U.S. shale players are going to fit in this next few years on the supply response?
Sure. Thanks, Rob. So first of all, I do want to say that I hope Mike is right, and I hope we're wrong, because I think a $50 to $60 a barrel crude price environment is a lot healthier for the world economy than the prices that we are seeing right now. And I think one of the reasons why, going back to kind of Will's points, which I agree with, I think when we saw crude prices go towards $100 a barrel, kind of a bearish sentiment we had last week, I think a huge headwind and a huge overhang for that was the lockdowns in China, because this week, when we heard Shanghai was reopening, we are back to being above $110 a barrel for both Brent and WTI, which shows that in the next few months when China reopens, and on top of that we have kind of jet fuel demand coming back, and on top of that we have the summer driving season, which are all, I think, going to support oil prices. And it's already, I mean, when we look at this physical market, it's already a pretty tight market that is about to get even tighter. Of course, in a longer time period, I do agree with Mike. I think he makes a very compelling argument. So when it comes to, I mean, Will has mentioned this as well, but when it comes to rebalancing the supply-demand for the oil market this year, we generally kind of rely on OPEC and OPEC spare capacity to fill in the gap when demand continues to rise. But what we've been seeing is most member nations really struggling to deliver these output hikes within OPEC. And at the moment, we suspect that most of these member nations, except for probably only Saudi Arabia, the UAE, and Iraq, are already at or near their maximum capacity. So I don't think on the supply side we can really rely on OPEC to fill in that gap. So what that leaves us with is the US shale. But for the reasons that Will mentioned, I don't think we will see US bringing in enough supply to rebalance the market this year. I mean, our scenario analysis suggests that the incremental increase in U.S. supply this year will be about 800,000 barrels per day, less than 1 million barrels per day, which really leaves kind of demand destruction, the demand side of the equation, the final lever to rebalance the market. And to going back to the first part of your question, kind of the UK windfall tax potential. So in our note, we're arguing that this is very unlikely to pass. I mean, we understand the kind of the political side of this, and obviously the cost of living, especially in the UK, just like in many other parts of the rest of the world, is getting more and more expensive. And there is increased pressure as people see how much profit these companies are making. There is increasing pressure on politicians to bring this one-off windfall tax on some of these companies such as BP, Shell, and some of the other pure upstream North Sea players. But we shouldn't forget that only a couple of years ago, these companies were making record losses. And we should also forget that last year, oil prices for a day went to negative. So I think it is not really the solution to be taxing these companies rather than kind of trying to fix the policies to address the energy security. And I think the argument that these companies have been making is that this type of one-off tax would actually crimp investment, a very, very important energy investment by these companies that they need to be making at a time like this where we've kind of learned how important energy security can be, and also at a time when we are in the middle of an energy transition where we really depend on these companies to increase spending in low carbon solutions to transform their businesses into kind of away from oil and gas and other legacy businesses into renewable solutions. So for a very long answer because I think you had a couple of questions in there, but that's generally our thoughts around the macro situation for oil and the potential windfall tax that the UK is considering.
Okay, thank you, Salih. Mike, I want to come back to you. Okay, so you've heard Will and Salih lay out the case about near-term tightness, especially without Russian crude oil on the market. On the long-term horizon, though, you noted both of them talked about energy transition. So I want to get your view on how does the oil market respond to increasing competition from EVs and other technologies that are trying to erode demand. Hopefully we erode demand through technology as opposed to an economic shock, but tell us how you see it.
Well, let me tell you, my first observation is when I love speaking to my younger colleagues, because you're the same age when I was in the trading pits, and think of yourself when you're my age. I want to lose this debate because I want to win the outlook to help customers make money. That's the bottom line. That's what I've done all my life. And this transition that's happening in EVs is the most significant in the history of mankind. in terms of retooling of automobiles. So let's look at one fact is liquid fuel consumption in the U.S. peaked in 2005. That's right around when people at Goldman Sachs told me we're going to have peak production. Now, remember, I've been there, done that. I've seen it. Like, thanks, guys. I saw a lot of those guys get fired, too. And now it's going down, but it's not because of EVs yet. That's just because of efficiency. Now EVs are kicking in. Now, how many of you own an EV? I do. I have an electric bike. And I did it with subsidies. I have solar panels in my house. I won't speak to it unless I believe in it. It's really happening. It's happening fast. Just look at like garden tools. 20% of garden tool sales now, things that used to be used like hedge trimmers and stuff now are all electric. It's just a matter of time. It's just can't stop that trend. What does that mean? Demand for metals. And we even know, even because of that, copper is still not doing well and silver is not doing well. So I look at this as crude oil is a redundant commodity. It's becoming redundant rapidly. Now, we're always going to use some of it, but the massive source of demand for it is over. And that's part of the reason, as I like to point out, it's still below the peak from 2008. And now that downward trend is accelerating. So you never get good long-term bull markets in commodities unless you have that demand side. And we're talking about supply. So that's the problem right there. I remember hearing that from Jeff Curry a few years ago when he was telling me, supply from OPEC is going to be cut and everything. And Mike, you're missing the point. It's demand that matters. Demand's going away more rapidly than any time in history. It's just taking a little time. Now, to me, in the bigger picture, and what's going to happen this year is that's the macro. And that's going to not matter so much, but for the people who really focus on the producers and in things, in terms of prices, it's going to matter. The micro is the stock market is corrected almost 20% from the peak. The highest correlation, we have the highest correlations ever between commodities and stocks, except for the last few months, potentially because of the war. And the Fed chairman still says we need to hike more. He is jawboning on purpose. This is from someone who used to work at the Fed, work at a primary dealer before we had the openness. They will not stop tightening until the stock market goes down more or crude oil goes down more. And every time crude oil goes up, they have to tighten more. You see the lose-lose there? And to me, that's what's going to happen. It's one of those things that's going to just be like 2008 when we went up to 145 and down to 40. 1990 went up to 40, down to 20. To me, that's the greater risk. And I see it happen so many times when people allocate the commodities at the wrong levels. You're supposed to buy them. You're never supposed to buy commodities after they go up. It's just a poor thing. And what you pointed out is that revolution in advancing technology. So and in this, why is the U.S. and North America now a massive net energy exporter and the largest agriculture exporter on the planet? For one key reason, harnessing that advancing technology.
Okay, speaking of technology and energy transition, let's switch gears a little bit and talk about the gas market. Oil hadn't seen anything compared with what's been going on with gas here in Europe, frankly. We're up over 7x compared with a couple of years ago. A lot of it's driven by the Russia-Ukraine crisis. And so I want to go to Patricio first. Help frame what's going on with the gas market. Just this today, we saw the European Commission put out its Repower EU plan, which makes some pretty aggressive statements and objectives about what the region wants to do on renewables and curbing gas demand, these kinds of things. So what do you make of the proposal, and how's it going to play into what's going on the gas side of the equation?
There's a lot to unpack there. So I'll begin with the state of play for natural gas in Europe. So prices are still trending close to 100 euros per megawatt, as you said. That is nearly 4 times what Henry Hub is trading in MBTU terms. And this is a result of an extending supply crisis that we saw begin towards the fourth quarter of last year, given the region's low storage levels at that point, given Asia had stripped away a lot of those LNG cargoes that were supposed to flow to Europe. And since we've seen this improve very little since Russia suppressed gas flows even before the war. So with the beginning of the war a couple months ago, that this just exacerbated these conditions, and we haven't seen significant gas suppression from Russia quite yet. But this seems to be the lingering risk, I think, for all the buyers. We've seen Poland and Bulgaria being cut off a few weeks ago for not complying with the ruble payment demands, and we've also seen Finland sort of already walking down that path, saying that they will stop purchasing gas by the end of this month. So we see this lingering risk of a huge that may have huge structural impacts on the European gas markets, which is a risk for a lot of the utilities I cover, and would definitely require significant political intervention. So with that in mind, we're still seeing the price trending towards our extend scenario, where we see this looming geopolitical risk. And we've seen also, on the other hand, increased influx of LNG, especially from the US, during the first quarter of this year. And that has helped quite a lot. And we see if Russia doesn't curtail flows significantly and the US is able to keep this pace of LNG up throughout the year, we can see storage levels in Europe back up to 90% full by the end of September, which is the target that the EU is having. So we see, we're still trending up, but there is huge, I'd say, upside risk in the event of more curtailments from Russia. And other than that, I would agree that perhaps we can see prices ease in 2023, given that Europe gives to that storage target. And switching now to the Repower EU, I haven't had time to fully digest the whole document, but in general terms, it appears at face value as an acceleration of the previous Fit for 55 package. So we're seeing an increased ambition to install solar, to more than double solar installed capacity in Europe to 320 gigawatts by 2025, which is a significant step up. And this includes legally binding instructions for new developments, both residential and commercial, to have solar PV on the rooftops, which I think was something to highlight. And we've also seen an increased emphasis on energy efficiency, which I think it's interesting, particularly interesting after what Salih was mentioning, that you get to this point in the supply-demand balance where it's increasingly likely that demand destruction will feature, especially in gas. If Russia curtails gas flows before, I'd say, maybe 12 to 18 months, there will be meaningful demand destruction in Europe, as there's just not enough short-term supply levers to make up for that, given that Russia accounts for about 40% of the region's gas supplies.
Darja, I want to come to you to get a response on that idea. You cover PGNiG, Polish E&P. They're very exposed on this idea. What's the gas flow situation look like from them, and can U.S. LNG come to the rescue for a country like them?
Sure, absolutely. So I'll probably echo a lot of my colleague Patricio just said, but narrowing it down to Poland specifically. So if Europe's dependent on gas is about 40%, then for Poland that's actually about 50%. And indeed, gas flows to Poland were halted upon PGNiG's refusal to pay for gas in rubles. However, no immediate gas shortage has followed. Poland's shortage is actually filled to 89% capacity, which is 13% more than on the day of the halt, where Poland was only at 76 storage full. Now, that's partially because Poland has continued buying Russian gas through the reverse flows from Germany. But more importantly, PGNiG has made provisional steps in anticipation of the event well before the Russian-Ukraine conflict has emerged, securing LNG deliveries from the U.S. and Qatar through long-term contracts, tripling its LNG portfolio. And more recently, they had secured an additional 4 billion cubic meter contract with a U.S. LNG provider, Sempra. However, the deliveries won't start before 2027. Now, together with the Norway-Poland pipeline, that will be expected around the end of the year, bring in an additional 2.5 billion cubic meters. That should be just enough for Poland to cover 50% of its gas demand, which was previously covered by Russia before the gas halt.
Thank you, Darja. Okay, Mike, I want to come back to you. I know you don't live and breathe as much in the gas world, but if it's not apparent, we need the U.S. to send more gas to Europe right now. That is essentially what the market is screaming. That's why you see this big price differential, and you have seen U.S. Natty gas going up here recently. Is this something that's going to keep pulling the U.S. gas price, or does Henry Hub have its own fundamentals? And are you going to see some mean reversion there? I guess my point is your story on gas similar to your outlook for oil?
Yes, the latter, which I believe the forward curve. The 1 year curve is the best way, I think, to look at commodities. You should stick with 1 year. It's us, the backwardation in gas 1 year is the steepest ever. I mean, that's pretty, be able to say. I think it goes back to year 2000 is pretty close. And that forward curve gas at 8 right now for June is gas in June 2023 is at 4. I believe it. I think it's going to be more like that because we know we can only export maybe 12-13% of LNG of total U.S. gas production, and there's just sustain in the U.S. So I've learned since gas peaked at double the price it is right now in 2005, there's an ocean of natural gas in the U.S. And I think so. That's just a lesson I've learned. I think it's pretty extreme right here. But that's the thing. You just can't export it yet. The point is, what happened with this pandemic and how the world is able to come out with vaccines needs to be transmitted into what's happening now. We have a pretty severe energy crisis. The key thing to remember is what you started out with, Rob. Gas prices up 7x in Europe. You cannot have that without demand destruction, and I'm pretty much guaranteed you're going to have a European recession. Obviously, you're going to have a collapse in Russia and potentially a recession in the U.S. It's just happening, and energy is part of that. So it's its own worst enemy. But the key thing to remember about gas is there's an ocean of supply in the U.S., and the price on the screen is probably triple the cost of production. So you have to assume we're not going to bring that production back. You have to assume the laws of economics don't matter. So I look at it, the bottom line for gas is it's major dichotomy between the U.S. and Europe. All the major commodity indices, Bloomberg Commodity Index, the GSCI has U.S. natural gas in there because of liquidity. So that's going to matter more. And it's also, remember, natural gas is the world's worst investment in the history of mankind because you always got to pay that storage. I mean, the only one index I ever had to rebalance when I was running commodities at S&P was the natural gas index because it started at 100 and went to 0 because that's the way it works. You want to buy the producers, and the producers are crushing it. So I look at it like, believe the forward curve. If it sustains above here, that's going to have its own demand destruction problems. It's already happening. So a key thing I'll leave you with is it's happening, and if it's happening in the U.S., it's much worse than Europe because we don't have as many inflation issues as you have. $4 for a gallon of gas compared to what, 8 or 10 in Europe. I mean, I live there. But you're seeing the majors decline, the retail, Amazon, Walmart, Target, and they're the ones that are showing that demand destruction is kicking in. They're early indicators. So to me, this is, we're talking about gas, but gas is, it's just, I'll end with this. The entire state of New York is still restricting the production of its gas. There's an ocean of gas underneath the state of New York. All you need is one little Defense to Production Act. And remember, we have midterms elections coming up, and if energy prices go down, the Democrats are more likely to get elected, and who's in power?
A quick advert. Our colleague Vince Piazza in the U.S., who covers some of the U.S. E&Ps there, has a focus idea on natural gas, and I think he's largely aligned with the way you see it. So from a fundamentals perspective, so check out his focus idea. Okay, so time is flying. So much has been happening in energy markets. If we could sort of quickly do a quick round robin for everyone to close out and just kind of maybe hit on a highlight from earnings that we've just went through, because we haven't even talked about earnings. That's a big part of our franchise, is sitting on the earnings calls, updating our models, and putting out our outlooks for what's next for the companies. So, Darja, give us a sense, what was the big story in refiners in Europe over the 1Q?
Sure. So with the refiners, we're going through unprecedented times with this with the refiners across the space enjoying the elevated refining margins, which we saw going beyond $50 a barrel. Now that's significantly higher than the 5-year average of mid-single digits. And with the refiners, we saw a lot of them really enjoying their cash, their profitability, their earnings, boosted through the expanding refining margin. So I would like to highlight the first refiner which reported in my space, which is Lotos, a Polish refiner, which done really, really well. Their refining margin shot up for the Q1 at 17.2. Now for the Q2, it's going to be significantly higher, a multiple higher of that, and that's really exciting. And I'll close with this. The spread can be explained in two folds. Very quickly, first of all, Russian crude oil is being sold at extreme discounts due to Brent oil differential, which is bringing the cost for the refiners down. Now, at the same time, there are far fewer fuel products, such as diesel, in the market, which is, again, driving the price for diesel up, which is very beneficial for the refiners. So a lot of highlights.
Fascinating. Okay, Salih, over to you. What's the 1Q highlight from your franchise?
Be quick because I know we're running out of time, but I will highlight Aramco, which I think is quite interesting and kind of speaks for the rest of the sector, I think. I mean, one highlight is downstream. As Darja mentioned, the refining margins at the moment are incredibly favorable for these companies. So profitability in downstream for Aramco was actually at around $10 billion for the first quarter, which is more than double the amount they had in the first quarter last year. Overall, for the group, they had a free cash flow of about $31 billion, which is just insane, which is more than enough for them to be covering their quarterly dividend of about $18.8 billion. And this is obviously really helping them kind of bring their gearing down, kind of further repair their balance sheet. And yeah, I mean, it's just, I mean, obviously they're not alone, across the space. It's been another very strong first quarter with all segments, I think, firing and doing much better than they did in the last couple of years.
Fantastic. Will Hares, I assume pretty similar for your space, but tell us 1Q highlights from the European oil majors.
Yeah, European oil majors, record adjusted cash flow, record earnings delivery, and we're seeing that translate into, very strong recovery of buyback policies. Dividends will continue to recover. It is what we're calling the golden age of free cash flow for this sector, and that is not slowing down anytime soon. So we expect further dividend recovery for those that haven't built their policies back up to pre-pandemic levels, and continued large buyback programs being deployed with distribution yields in excess of 10% for the group, which is unprecedented.
Okay, last but not least, over to Patricio. Give us a sense quickly, what's the one key takeaway for some of the more utility-like names in Europe?
So very much mixed results, and trying to build on what Salih and Will said, I think we saw record margin pressure though, because that was the immense pressure of the wholesale power volatility is weighing on retail focused utilities that are not able to pass on these really elevated costs onto their customers quick enough, and it's sort of hanging still on the balance. And on one good, let's say, example of this, for example, is ČEZ, which is the power generator, the main power generator in the Czech Republic, has a lot of nuclear and hydro capacity, so it's been benefiting from the elevated power prices quite substantially. And we've just recently seen comments that the Czech government may push to intervene the company and potentially split it up. So this, for me, marks the main, I'd say, issue for the next 12 months for my sector is most companies that are integrated will try to bear the brunt of the volatility without squeezing earnings too much and hopefully capture some growth beyond that, but placing power sales at higher prices with hedges. And the other one is hopefully navigate regulatory risks, which so far have included price caps, other type of interventions, reduced VAT, and just any sort of measure that would delay the pass-through of the higher costs onto customers would really squeeze the sector. So it's still on the balance, mixed results. I'd say there's more risks to the downside at the moment, but we'll see how things develop.
Okay, and Mike, since you're our special guest, it's always a pleasure to have you on. I want to give you the last word to close us out. I think your vision is good news for the average Joe on the street, not so good if you're looking at some of the companies we look after. But what's your final thought on commodities as we head into summer?
I think it's a good chance we're going to head towards just revert back to the 5-year moving averages in most commodities. In crude oil, that's around $60. In gas, that's around $3. And the S&P 500, that's around 3,200, which would mean a 20% correction. And if we don't do that, the Fed's going to make sure we do that. That's where I'll leave it.
Thank you, Mike. I hope that you and Will get a chance, go to the beach this afternoon. I don't know. What do people do in Miami? Hopefully something cooler than here in London. For anyone who's listening, if you look at the companies we cover, we've got a lot of calculators that we've been building over the last few years. So if you run a function called MODL for, the European oil majors, it allows you to see a detailed form of consensus, and you can even play around with some of the companies and put in your own assumptions for, say, realized oil price, these kinds of things. So check out MODL, look at our calculators. It's an additional lens for thinking about some of these topics we've just been running through here today. As always, feel free to reach out, say hello, ask us questions over IB or email. And, of course, I think pretty much all of us are pretty active on Twitter and LinkedIn, so say hello there as well. And I hope you have a great rest of your week. Thanks, everyone.